Hey guys, Billy Ephart here. Thanks for watching the vlog. In fact, if you like it, make sure you hit like or share. And I have some questions that have come in from the vlogs, and especially on real estate and business. Today we're doing real estate, and this one is it says what is a good down payment to put down on a house? Well, typically the way down payments work with normal, what we call conventional type financing, is typically you would have to put 20% down to be able to buy a house. And that's what we call conventional financing, where you don't, if you put 20% down on what we call a regular purchase mortgage, then you do not have to get what's called private mortgage insurance or mortgage insurance. Some people call it MI, some people call it PMI, but that kind of insurance you'll have to get if you don't put at least 20% down. But here's the good news in this day and age, especially for those of you that are just starting out, especially if you're buying what we call an owner-occupant home, a home that you're going to live in. There are programs out there that are available, and you can talk to your mortgage broker and or banker, depending on who you know out there. But there are programs that you can actually get into a house for as little as 3% down if you're going to be an owner-occupant. So that's an amazing thing. Think about it. On a $100,000 house, you only have to put $3,000. On a $300,000 house, it's only $9,000. So if your income, what we call the verification of your income, and your debt ratio that you would have, debt to income ratio, is good, then you can just put 3% down and buy a home. So typically somewhere between the 5, 10, and 20% numbers. Now, if you're an investor and you have more than what we call 4 properties with 4 mortgages, then typically as an investor, you're going to have to put more down, up to 25% down. Now, there's ways that we teach you how to be able to purchase homes without having to do that as you start developing more banking or lending relationships with people. Some people, if you buy houses right, some private lenders, and then some banks, if you have a good relationship, can end up actually lending you the majority of the purchase price of a home as an investor, even when you have multiple properties, if you're buying those properties for less than they're worth. So if a house is worth $100,000 and you're actually buying it for $80,000, then typically it's called loan to value. Typically you can actually purchase that house for less than having to have a large down payment, just simply because you're buying it for less than it's worth. So typically if you're watching just to purchase your own home for your family, typically what lenders like to see is they like to see a credit score that's ideally at 720 and up. You can get them for 680 and up, credit score 660 and up, but you put 20% down, you get better terms and better interest rates. The lower down payment from there that you put, typically sometimes your interest rate will be a little higher, or you have to do what's called mortgage insurance on your property. And so I just encourage you, if you never got into real estate, you never started, I encourage you to start looking actually at real estate as an investment, not just as a home to live in. So, hey, listen, thanks for watching the vlog. I hope this helped you, and I'll look forward to seeing you back here on another vlog. Bye-bye.